So as mentioned, I'm the CEO of Trident Royalties. By way of very, very brief background, until recently, Trident was a shell company. We were listed on the London Stock Exchange. However, we IPO'd on the AIM just in June this year, and we did so alongside a £16 million equity fundraising, which was done in order to execute on our strategy, which is to build a diversified portfolio of mining royalties and streams. And our ultimate objective is to provide investors with exposure to the full sort of spectrum of diversified mining commodities, and ultimately with dividend income. And on that front, I think we're off to a very good start. So, yeah, let me jump straight in and give you an overview of what we're doing. Obviously, the standard sort of disclaimer here. I believe the presentation will be circulated afterwards, so more than happy for everybody to read that on their own. So the first question, one we obviously get quite often, is what exactly is a royalty? And it's very, very simple. It's effectively a financial instrument. And sort of royalty 101 is basically the royalty provider, in this case Trident, pays the operating company, the mining company, an upfront payment. Usually it's to advance an asset along its sort of development timeline, or for construction, and in exchange they get a portion of that asset's revenue, usually in a percentage. Now there are sort of a million different ways you can slice and dice that and have, you can have all kinds of nuance around that, but that's effectively the structure. And so there are sort of two buckets in terms of building a portfolio of these financial instruments. You can write royalties directly to the mining companies, as I just described, or you can acquire existing royalties. There's obviously hundreds of royalties out there in the world over all kinds of assets in all kinds of jurisdictions. And a lot of those are held by existing royalty companies, but even more are held by all manner of parties where it would be considered a non-core asset. So held by private equity or credit funds that have a fixed life and have to sell those assets, or held by private individuals, or many are held by miners themselves that as they sell a property, they retain a royalty over it. And but these are non-core assets, and they get the most value when they're consolidated into a mining company, a mining royalty company. So there are sort of two avenues for us to build out our portfolio. And as you build out the portfolio and you get diversification, you get cash flow, that's ultimately the objective. So I'll talk to our transactions that we've done thus far in a few moments, but we've got examples of acquiring royalties from both of those buckets. So then the next natural question we get from investors is, why should I hold mining royalties? In fact, it's sort of two questions. Often it's, why should I hold mining royalties? If I like a particular asset or a particular mining company or mining jurisdiction or geography, why don't I just buy shares in operators in that area and get that equity exposure? And then the alternative question is, if I like a certain commodity, I want to have more copper or gold in my portfolio. Want to have more real assets, particularly in times like the days we're living through now. Why don't I just go out there and buy direct exposure to that metal? So taking those in turn, with regards to why royalties over, say, mining equities, there's a few reasons for this, but first and foremost, it's the fact that a royalty sits at that very top line of the P&L. So, we get a percentage of their revenue. So cost can do, what it does and ebb and flow sort of below the revenue line. And equity sort of has to wear that uncertainty, but the royalty sitting there at the top line gets all the sort of revenue exposure without any of the operating cost or capital cost risk that's associated with equity. Now, the other big benefit to holding royalties to get your mining commodity exposure is that when miners, particularly when times are good and commodity prices are up, miners have this sort of notorious reputation of going out there and spending some of that money. So some of it obviously does flow down to shareholders, but quite a bit is spent on additional drilling, plant expansions, M&A, sometimes ill-advised M&A. But they're effectively using equities money to do that. It's the profit at the end of the day that they use to execute on those initiatives. But the royalties still benefit from that, from those sort of endeavors. So if they go out there and drill and increase the resource life, that increases the life of the mine, which increases your stream of revenues, which directly benefits the royalty. Similarly, if they expand their plant, that increases the throughput, which increases revenue, which benefits the royalty. So you get all the benefits of the operational assets similar to equity, but you're getting it from a top line perspective. So in that sense, it gives you a lot of the upside, all the upside without sort of the same level of risk. And then the sort of second question of why don't I just get direct exposure to the commodities that I like versus getting it through a royalty. Again, it comes down to that asset exposure. So, for example, if a mining company in year 3 of its operational life increases their plant size and increases throughput by 30%, obviously that benefits revenue and that impacts both the royalty and equity. But as a very with regards to just getting the commodity direct exposure, you wouldn't get that sort of asset exposure. And apologies, it sounds like having an issue with my webcam.
Adam, for what it's worth, I can see you and hear you fine.
Okay.
Yeah, so please carry on.
Okay, yeah, great. Yeah, so those are really the benefits of royalties. Now, sort of first thing is then what exactly is Trident doing? So what we want to do is construct a portfolio that broadly mirrors the commodity exposure of the mining sector. So at the moment, most mining royalty companies are focused predominantly on precious metals. But what we found is that I can extol all the virtues of royalties, what I've just talked about on the previous slide. And investors, they get it. It's quite intuitive. These aren't sort of complex financial instruments, and most investors should have a real asset allocation in their portfolio, and a portion of that should be coming from commodities. So the next natural question is, well, where do I get that exposure? I like royalties. I want to get my exposure that way. So what shares do I hold? And at the moment, that offering is just not out there. So we want to build a portfolio over time that allows you to hold a single share of Trident and get that broad, diversified mining commodity exposure. And as mentioned, we're going to be doing that by going out there and acquiring both existing royalties from natural sellers, which we've already done, as well as writing new royalties, which we've also already done. And we'll be acquiring royalties then in resource-friendly jurisdictions, in particular royalty-friendly jurisdictions. There are some countries that just don't have the legal framework to support royalties. But we'll talk to our portfolio in a moment. But our royalties initially have been in Australia and one in Zambia, and those are common law. You can tie the royalty to the actual claim or the tenement, such that if the operator, say, enters bankruptcy, the royalty survives and it's effectively tied to that ground in perpetuity. So that's what we mean with regards to seeking out sort of resource-friendly jurisdictions. Important to flag the low overhead model. This is something that you'll see all the mining royalty companies sort of shouting about. In particular, they love to bandy about their revenue per employee versus the miners, and it really is quite simply down to the fact that well, we're not operating mines, so the mining companies have big headcounts because they're operating complex mines. A royalty company, it's effectively we're classified as an investment company on AIM, so we acquire these financial instruments. We effectively put them in our wallet, audit them from time to time, obviously monitor the assets, visit them, that sort of thing, but you're not actually operating and managing a mine. So it can be done with a very low headcount, and there are numerous examples of multi-billion-dollar market cap mining royalty companies that that have headcounts in the sort of 20 to 30 range. So it's a very scalable business model. As you double the size of your portfolio, you don't even come close to doubling the size of your G&A. I mentioned at the very beginning, we're well positioned to execute on the strategy. Obviously, you need capital to start going out there and acquiring assets. You can use scrip as well, and then you can get leverage against a portfolio of diversified cash flowing royalties. So there's a lot of options available to us, but I think we're probably one of the best, if not the best positioned junior royalty company with regards to access to capital. And then if time allows, I'll go into our CVs in more detail. They are on the sort of back end of the presentation, but the quick summary is that we're all mining finance professionals. The bulk have technical or legal backgrounds, and this is far from our first rodeo. So moving ahead, I think in terms of why we see an opportunity in the space, it's probably helpful to maybe lay the groundwork initially. If you rewind the clock back sort of 15, maybe even just 10 years, this list of publicly listed mining royalty companies would be sort of 2 to 3 names long. So these are big companies. Obviously, you see Franco there at nearly 28 billion market cap. So a big space and a very established part of the mining finance landscape. But also in its sort of adolescence, in the sense that it has grown over the last sort of decade, and a lot of the entrants are relatively new. And what that means is that there's that good combination of a well-trodden path of growing a royalty company, but also still areas of opportunity. A couple of things probably jump off this slide as you're looking at it. The first is just how many of them are precious metals focused. So royalties and streams largely had their genesis in North America and financing the construction of precious metals mines. So, it's unsurprising then when you look at the space, still very heavy precious metals focused. So when we look at building a diversified portfolio, when you look at the peers that are not precious metals exclusively or predominantly, Labrador is a single royalty over the Iron Ore Company of Canada. So it's effectively passively managed and no longer building out a portfolio. Altius and EMX are predominantly sort of project generation, so they'll acquire ground and sort of drill it out and then spin it out and retaining a royalty, and they've been very successful at that. They will do some direct royalties as well, but again, slightly different offering. And then Anglo Pacific's well known to the London market, predominantly coal at the moment, but I suppose more fundamentally with regards to a difference from Trident, they're just at a different stage in their life cycle. They're larger dividend paying sort of company, and we're very much a growth company where each transaction is sort of really a significant increase on our portfolio. So when you look at the space, there's just not many options. And as I said, there's not an option at all for investors that want to get their mining commodity exposure from royalties to get it from a single holding. You can try to piece it together and get the diversification you'd want, but even that's a challenge. So we think we're coming out with an offering that's in some ways very intuitive, but it has not yet been executed on. And as mentioned, I think we're off to a very good start in that regard. Now, there are a couple other sort of tailwinds that we think will help us. One is that all these companies, with the exception of Anglo-Pac, have their primary listing in Toronto, and they are very heavy sort of North America focused. And it's actually unsurprising. You overlay the royalties on a global map, and it's very heavy North America, and then sort of trickles down into Central and South America, and a smattering sort of elsewhere. But places like Australia, where we acquired our first couple royalties. Obviously one of the biggest mining jurisdictions in the world, hundreds of mines, hundreds of royalties in existence, plus many more that you could write, but not yet a single publicly listed mining royalty company. So places like that are ripe for consolidation. And our royalty in Zambia, again, producing Zambian copper, very attractive asset, but just falls outside the purview of nearly all of these peers. And the final thing on this slide is just the size of some of these companies. You'll see quite a few are sort of the plus billion market cap point, but even the ones that are sort of in the mid-tier range, sort of call it 300 to 500 million US market cap. Occasionally you see the bigger guys write a smaller royalty over an early stage asset, but it's typically an asset that they think 10 years from now has the potential to be huge. What you don't see them do is write, say, a $5 million check over an asset that's going to pay, making up numbers, but say 1.25, 1.5 million per year for 10 years. Now that could be obviously an incredibly accretive transaction, but if you've got a market cap of 8 billion, that doesn't really move the needle. So there's a size opportunity as well as geographically and obviously diversified. Now, the one area where the precious guys have actually helped us tremendously is they have sort of laid out the pathway of building value as you develop your portfolio. So, initially you are sort of valued on a single asset and then a couple assets and then a smattering of assets. But as you sort of coalesce and you build your portfolio and you're not valued any longer on sort of single asset exposure, you're valued on a diversified basis. You see a re-rating in value, and there's a couple then sort of obvious steps. One of which is to introduce conservative leverage against the portfolio. Once you've got diversified cash flow, you can get lower cost of capital debt, which is a sort of the next step. And obviously we've got the non-binding debt mandate with Tribeca and are progressing debt discussions more broadly. And then the next thing is you can obviously do transactions using your scrip. So for the holder of a royalty as a non-core asset, they're not getting much value for that royalty. For example, well, you can acquire that royalty, vend it into your portfolio where it is going to get better value, but they still get to retain the exposure via scrip. So that's another way to sort of build your critical mass without just burning through cash and needing to do consistent equity raises. But then finally, once you've done that, you can get to the point where you are at the stage where you're issuing a dividend. And our objective is to let as much of the cash flow, once we build critical mass, flow through via dividends to shareholders, so that they are getting that direct exposure to the commodities very clearly through a dividend. I won't dwell on this one, just given the time. But I think, what it does demonstrate is, that chart in particular, the x-axis is in number of days since inception as a royalty company. And these are a few of our precious metals focused peers in North America. And what it does show is there is that period of sort of establishing critical mass before then the share price really reflects it as you're able to execute on things like getting leverage and issuing a dividend. There's a very clear sort of inflection point. So we're very much at the exciting stage where you're building critical mass. Each accretive transaction is another step towards towards that sort of launch. And so, we're looking forward to the point where a few years from now, we'll probably be at the boring stage where we're just issuing a dividend and replacing our cash flow by acquiring royalties as other ones roll off. But at the moment, we are at sort of the really exciting part. I think exciting for us and exciting for shareholders, because this is where you see a lot of the most exciting activity occur, where we're building up that volume that's gonna propel us in the future. And then just real briefly, as we don't have a ton of time, I'll go through a few of our royalties. Less on sort of the technical aspects, although I'm happy to answer any questions on it, but predominantly on sort of how we sourced them, return hurdles we were looking for, a bit of a snapshot of the royalties. I think it'll give everybody a bit of a view of how we're sort of putting the portfolio together. So the first royalty that we acquired was over Cooley-Nobbing, which is an iron ore operation in Western Australia. Now, this is an example of a royalty that was held by an ASX-listed junior who owned this ground sort of 10 years ago. When they sold it, they retained a royalty, and then it sort of sat in the bottom drawer and an off-balance sheet, for the next 10 years. But then, lo and behold, Mineral Resources, a big ASX-listed major, picked up the ground a couple of years ago, and then last year ramped it up from a 6.5 million ton to a 12 million ton throughput rate. And then just updated their quarterlies last night, and sort of are now sort of advancing that and targeting 13 million tons next year. So from our perspective, this was our first royalty acquisition, was done with the cash that was originally in the Trident shell, so we were a little constrained in that regard. But this was a royalty in a good jurisdiction that's operating and paying, operated by a major. They're ramping up the asset, which obviously lowers cost as you increase production. They've allocated 120 million Aussie to do so, so they're investing in the asset. So it ticked a lot of boxes for us. We officially closed on it in June for 7 million Aussie, 4 paid in June and 3 in June 2021. And it's already paid us back 1.4 million Aussie through the first half of 2020. And iron ore prices, we inked this deal when they were in the 80s, and now they're sort of in the 120s. So in fact, I think it maybe has just surpassed gold as the best performing mining commodity of the year. So it's a very solid royalty sort of straight out of the gate. Our second royalty was over the Mandura copper project. Now, this was a royalty that we wrote ourselves, so it was not pre-existing. Probably the key thing to flag on this one is it's a good example of when a mining company would want to take on a royalty. So, because there are many cases where people would say, why would a miner want to burden themselves with a royalty? But in this case, they were just ramping up production, but their cash balance was getting a little bit tight prior to being in revenue. Now they're in revenue now, so that's sort of eased off. But they wanted to shore up their balance sheet. They didn't want to do sort of a quick, hurried equity raise in the midst of ramp up, because that would sort of set share price expectations, and debt would obviously be too slow. So they were open to a royalty if we could structure it in the right way. So the way we did structure it is a 1.25% gross revenue royalty, and then once we've recovered our $5 million investment, it steps down to a 0.3%. So what that means is for every $100 they generate, we get $1.25 of it, and then it steps down to 30 cents thereafter. So that's a structure that that worked for them. They don't see it as anchor around their neck, particularly given the scale of the operation that they tend to ramp up. So You can see it's nearly 100 million tons at 1% copper. It's very, very substantial operation, and it's going to have a long life. So from their perspective, the 0.3 residual royalties is almost a rounding error. For us, it's still meaningful. So we get our money sort of back off the table very quickly, and then we get that residual interest that I'm sure will be paying us 10 years from now. The other thing with this one is because they are on ramp up, we put in a minimum payment schedule. So they pay us $375 per quarter minimum starting next year, and then that increases to $500,000 per quarter in the following year, and then in 2023, the first 2 quarters, $750,000 per quarter. So what that means is effectively we're repaid our $5 million within 3 years, and obviously if they hit their production targets, it would be earlier than that. And then just briefly, this was our first development stage royalty. It was in Australia. Probably the key thing to flag on this one is, rather than delving into the detail on the asset, is just the way we're approaching development assets, which is to conserve the bulk of our balance sheet for acquiring cash flowing assets like Mandura and Kulinabing. But we still want to get development and exploration exposure into the portfolio. So the way we did this deal was there was a consideration up front, but then the bulk of the consideration for the royalty is actually paid once the royalty is paying us, and is paid on 25,000 ounces, they get a second tranche. And then when it's paid on 50,000 ounces, they get a third tranche. So what that means is at that point, obviously the development risk has been completely mitigated. It's producing and paying, and it also preserves our capital then to deploy on sort of bigger cash flowing royalties while still getting some of that development exposure into the portfolio. So that's broadly speaking how we're approaching getting exploration and development into the mix. Just real briefly on our pipeline, is a bit of a wonky metric to use with regards to active NDAs, but it's what the lawyers would let us get away with. But hopefully it does give you a flavor that we are reviewing a number of opportunities, and probably most importantly, that's coming across the breadth of mining commodities. So the 3 buckets I mentioned with regards to having a third of our portfolio in base metals, a third in precious metals, and a third in bulks and battery and everything else. We are seeing opportunities in all 3 of those buckets, quite a high volume of opportunities. And additionally, we're seeing a lot of opportunities in various jurisdictions. So I don't doubt that this time next year we'll have obviously a bigger portfolio, and it's going to be more diversified, both with regards to commodity as well as geography. As mentioned, here are our sort of quick snapshots. I am running sort of tight on time, so I'll skip over this. But as I said, we're all mining finance professionals. We've all been doing this for a while and have sort of technical or legal background, so well positioned to execute on the strategy. And I think our first few transactions hopefully speak for themselves. On the capital structure, we kept it quite intentionally as sort of a very vanilla structure. So there's management incentive options, but outside of that, it's just common issued equity, and all of our incentives are at the IPO price or higher. So we're quite conscious that we wanted to keep it as clean as possible and not sort of just have a muddy, complex structure there. And we're supported by a number of institutional, primarily resources-focused funds that sort of understand this sort of opportunity set and were willing to back us. So, Q2 highlights, obviously the listing, the capital raise, the debt mandate letter. We've acquired 2 cash flowing royalties. We've been publicly listed for about 2.5 months and have done 3 transactions, 2 on cash flowing royalties. Our first payment on the Kulinabing royalty was well in excess of the previous quarter's payment, as they're ramping up that asset and iron ore prices are strong. We're looking forward to Q3's payment, because that will be obviously Kulinabing, but then the addition of Mandura as well. So we'd expect again a sort of increase in our quarterly revenue. So we've been very active, and we're not taking our foot off the pedal, so to speak. So that's really it. I think I'm sort of right on the dot with regards to time, so happy to open it up to questions from here, Roland.
I guess to kind of start with royalties companies, as you mentioned, that kind of new to the London market, certainly for resources companies. When you had that initial raise, did the city get it? How did you find that kind of the London investor community understood the concepts?
Yeah, I think so. I mean, there is an education process, because the easier path is to go to Toronto, where it's a very well understood model. But that said, we've obviously got Anglo-Pacific with a mining focus already in London. The likes of Duke Royalties, they're not resources focused, but they've been a success on the AIM, going from effectively what we're doing. They went from a shell and have built up a portfolio, and Not sure where they're sitting today, but they built up strong liquidity and were over 100 million pound market cap pre-COVID. So yeah, there are a few examples of the model in London, but more broadly, it's not a hugely complex business model. So it is a matter of getting in front of people and educating them, and then letting the results speak for themselves. As our quarterly revenue increases each quarter, I think that will speak volumes.
And I guess this question that's come in is related to that. I think many investors are very familiar with junior resources companies raising more money, diluting existing shareholders, and going through that cycle. And as Trident grows, do investors face that same dilution each time there are equity raises?
Yes, I mean it's a good question. I suppose the biggest difference is we're not sort of a junior explorer developer that needs to constantly raise to fund the next sort of 6 months. We're already covering our G&A just from Coolinomic on its own, and we'll be covering it for the foreseeable future. And with the addition of Mandura, obviously we're more than exceeding our G&A. So we're generating capital internally that could be redeployed into new royalties. As mentioned, there's the ability to get leverage, and we're advancing discussions on that front. Once you've got 2 cash flowing royalties, and then you're getting leveraged against a specific third royalty allows you to then they're lending against a diversified portfolio, and so you can get cheaper cost of capital. And again, that's sort of well trodden for the mining royalty companies to go out there, and usually starts with slightly higher cost debt, and then they're able to sort of decrease that as they further build out their portfolio until it's just a revolver with the likes of a HSBC or Barclays. And so then that becomes the main source of funding. So you're not constantly diluting your shareholders. Now, there may be future raises down the track. I don't think what we would see is sort of a blind pool of capital that would be effectively what we did for the IPO. More than likely, it would be against a specific asset if you needed more cash to execute on that transaction. So it's a bit more managed in that regard.
And how much of the cash would you put into any one single investment?
Yeah, that's a tricky one because it obviously depends on the investment, and we're conscious of wanting to maintain a sort of balance in our portfolio. I mean, any transaction we do at this stage is going to throw that balance out of whack because we have 3 royalties. So as we add to it, it's going to sort of ping pong back and forth a little bit, but hopefully that gets narrower as we go. But the intent is you don't want to dwell necessarily in the realm of doing tickets around sort of 5 million plus or minus. You want to grow the portfolio and grow that sort of ticket size as you go. Now it's got to be managed appropriately. We can't rush out there and do a $50 million transaction tomorrow, but we do want to increase that sort of ticket size. And if we get to the point where we are then sort of head to head with the bigger boys, then I think both ourselves and shareholders would be very happy to get to that stage.
I'm sure. Question here, when are you expecting Spring Hill to reach production?
Yeah, that one, again, a bit tricky to sort of pinpoint because it is a development asset in a very hot gold market. So, I mean, if gold hangs up where it is today, we're sort of nearly all-time highs in terms of Aussie gold price, and that's going to push the thing forward faster than we were probably expecting. Yeah, internally, we're sort of thinking 18 to 24 months. Critically, this one is within trucking distance of a mill, and has done bulk sampling through that mill. So, very low likelihood that this thing would be built as a standalone basis. I mean, the reality is the way it would be developed is they get a mining contractor in there to start, picking up the material and truck it down the road and run it through the mill and just pay a toll treating arrangement. So the fact is it could be turned on very quickly, but we're sort of conservatively thinking 18 to 24 months.
And so how early stage would you get in on a project? And would you really go to that kind of straight exploration, blue sky stuff, or is that too early for you?
Yeah, we certainly wouldn't mind having it in the portfolio, but again, we're prioritizing our cash for more substantive cash flowing or very near cash flowing assets. So, if we can do a transaction that looks smart and has a couple exploration assets sort of tacked on, then we'll do that. But the focus is on building up cash flow, because that is one of the areas where we're quite conscious of. On the TSX, you could get away with being a royalty company that has development assets with a multi-year time horizon. But I think cash flow is going to speak volumes, being London listed. So we're quite conscious of that, and that is the priority.
Okay, and a question here on the Mimbula investment. You described that residual royalty. How long do you get that for? Is there a fixed time, or is it in perpetuity for the life of the mine or the project, or is there different arrangements for different investments?
Yeah, I mean they're all slightly different. So Mimbula, we get that 1.25% gross revenue royalty until we're repaid 5 million, and then it steps to a 0.3 gross revenue royalty until the royalty's paid on 575,000 tons of copper, which is a very long time horizon. And then it steps down to 0.2, and the 0.2 is there in perpetuity. We'll never leave that property, yeah, until we've all passed away. So it is a typical royalty where it's on that ground forever. The rate does sort of step down over time, but as mentioned, if we get to the stage where it's stepping down to a 0.2, I think we'll all be very happy with that sort of performance.
And question that came to my mind, you mentioned the small management team and how you can be very cost efficient in that sense. But would you also want to kind of get involved in any of these projects? Would you want to get your expertise and your team's expertise to help any of those companies that you're investing in, or are you completely hands off with you have the operations and the running of any mines or development projects?
Yeah, no, we're completely hands off. It starts to blur the lines a little too much if we start parachuting in and want to manage a project. And quite frankly, that's not what we're set up to do. Yeah, so the intent is that you find good projects with good management teams, and you like what they're doing, and you invest and you get exposure to that. But what we don't want to do is start trying to parachute in and get involved ourselves, because you can find very quickly that steers you off course of what our actual mission is, which is to build out a portfolio of royalties and generate that cash flow. So no, we won't be venturing into sort of operational aspects anytime soon.
All right. And one final question. You mentioned at the start you're at that growth stage. All things being well, when would you hope to be at the dividend stage?
Yeah, again, a tough one because it obviously kind of depends on what the future holds for us and how the portfolio builds out. Yeah, I think we're looking more at what sort of cash flow level we need to maintain a healthy dividend, and what sort of diversification we need. So we are working on a dividend policy now, but you do see it when you get to the stage where you're sort of plus 10 million in revenue. That's where you say let's issue a dividend policy, and hopefully then follow it up shortly thereafter with a dividend. And on our existing royalties, we'd be getting sort of close to halfway there. And obviously, we still have the bulk of our capital out there to deploy. So I think we're pretty well progressed in that regard, and we're very conscious that is our ultimate goal, is to return capital to shareholders. So share price appreciation, of course, but also to get a dividend back to shareholders.
Well, Adam, that's lovely. Thank you very much. Thank you for introducing the company to us and joining us this evening.